Joining us right now to talk more about the markets is Oksana Aronov. She is the head of market strategy for alternative fixed income at JPMorgan Asset Management. And what did you think of what you're hearing? This bounce back that we're seeing today, are you feeling more calm about things, about the questions when it comes to tariffs, about the questions when it comes to whether we're heading into a downturn or even a recession in the economy?
Look, I think the uncertainty remains, and we're going to continue to sit in this chop, both in terms of treasuries and the equity market probably as well, right? Treasuries have been essentially in a range with a lot of volatility in this sort of low fours, high fours. I think they're going to lunge back into the high fours, given some of the policy that's coming down the pike. But it is still being written. So uncertainty is not a friend of animal spirits. But one thing that we're seeing, and my broader point always is that, look, our job is to be prepared for a variety of scenarios. Look how the narrative has shifted from recession a couple of years ago, right? Didn't materialize. Soft landing. And now it's kind of moving towards, maybe a slowdown and higher inflation. So maybe the odds of stagflation are picking up. And that's not outside the realm of possibility. And our job is to never dismiss anything and be prepared. And I think that the Fed is certainly in between a rock and a hard place increasingly, because if we do see a slowdown and we continue to see this elevated inflation backdrop, what do? Do they cut to address the growth concerns? Do they remain, stay put, or even hike to address inflation, depending on what path it takes? Very difficult position that Jay Powell is in. And I think some of it is of their own making. They started the cutting cycle too soon.
So the hope for the markets is that you're going to see the Fed swoop into the rescue if the economy turns down. You don't think that that's likely to happen?
I think those days are behind us. I mean, it would take a very dramatic kind of, meteor slamming into the economy for the Fed to come. Your garden variety recession, I think those days are behind us, because when inflation is alive and well, as it is today, the Fed's hands are tied to deliver the kinds of cuts and the kinds of support that it's been able to deliver, in past downturns, including, when we think about what the administration is doing in terms of tariffs, and we expect that adds, roughly 0.5% to the inflation that we're currently running. When they were implementing some of these similar policies in 2018, inflation had a 1 handle on it, and now we have a 3 handle on it. And the Fed is always beholden to the inflation environment.
So if that's your thesis, what do you tell people to do right now?
So, I mean, look, at most, the Fed could cut once or stay put here, but it's just that the runway is very, very limited. And so my broader point is always we need to really evolve, particularly on the fixed income side, right? Because the equity investors have over the years been used to very volatile markets, significant losses, right? Price losses, et cetera. So that part of the portfolio has evolved significantly due to that. On the fixed income side, which investors rely on for stability, preservation of wealth, and all of those things, we haven't really gone through that evolution. And I think we need to really be prepared to be much more tactical. So, for example, in our portfolios, when the 2-year got up to 5%, we were buyers of that. We're not buyers of it necessarily now because it's sub 4.
Yeah, it's below 4%.
Have liquidity at the ready. You were just talking about the fact that, there are times to deploy it. And I think price returns, the kinds of price returns that bond investors got used to over the past 10, 12 years since the financial crisis are not there. And where you buy something really matters. So have liquidity at the ready to participate, especially given the amount of credit risk in portfolios. I think a credit reckoning is upon us. We are seeing an unprecedented amount of defaults for a non-recession part of the cycle. They're not sort of big, headline-grabbing defaults, but we're seeing a lot of companies default. They're just small companies. So in terms of number of defaults, that number is very high. In terms of the dollar value, it's low because the smaller players are finding it possible.
But that's the warning signs.
Exactly. These are the warning signs. So be tactical, have liquidity at the ready, evolve your portfolio construction.